If you've ever wondered why your credit score goes up and down, in this video I'm going to explain the terms that actually cause it. Not all credit terms matter equally. These are the ones that affect your score. Let's break them down. Hard inquiry. Hard inquiry happens when you apply for credit and the lender looks at your full credit report. This can lower your score slightly. Examples will be when you go to apply for a credit card or a car loan or a mortgage or really any other kind of loan. A soft inquiry. A soft inquiry is when your credit is checked for informational purposes, like a pre-approval or you're checking your own credit. It does not lower your score like a hard inquiry does. Here's the difference to remember. A hard inquiry is when you're applying for credit, when you're trying to get money, trying to get a loan. Soft inquiry is when your credit is just being looked at for information, so you're not trying to get a loan. So just remember, hard inquiry, application. Soft inquiry, information. Slightly different, but makes a little difference on your credit score. Payment history is a record of how you paid your bills. Were you on time? Were you late? Or did you pay them at all? This is the single biggest factor in affecting your credit score. Every time you make a payment, it helps. Every time you're late on a payment, it hurts and can hurt you for years. All right, minimum payment. Minimum payment is the smallest amount you're required to pay on your loan or credit payment without being late. You can always pay more than the minimum. Paying the minimum amount does protect your credit history, but doesn't always lower your balance or allow you to save on the interest. Statement balance. Statement balance is the snapshot of what you owe at the end of your billing cycle. And this is what often shows up on your credit report. Even if you pay later, this statement balance is what got reported. That's why timely payments matter for your score. Revolving credit. Revolving credit is flexible credit. You borrow the money, you pay it down, and then that amount that you pay down becomes available again. With revolving credit, your minimum payment usually changes when your balance changes. It's often calculated as a percentage of what you owe. As your balance goes down, oftentimes your minimum payment goes down as well. Installment credit. Installment credit is a loan that you pay back with fixed payments. So the payments don't change, the minimum payments doesn't change over time. You have a fixed known payment that you got to pay. An example of this would be a car loan, a mortgage, a student loan. These all have fixed payments. Here's the big difference. Revolving credit, the balance goes up and down as you spend money and pay it back. This greatly affects your credit utilization. Installment loans have fixed payments and fixed balance and does not affect your credit utilization the same way. That's why credit cards usually move your score faster than installment loans do. If your credit score ever changes, it's usually because of one of these things: inquiries, payment history, balances that get reported, or how you're using different types of credit. Not everything matters equally, but these are the terms that actually move that number. If this helped you understand why your credit score moved, then in part 3, we're going to cover interest, fees, and the terms that cost people the most money. This is Think Differently, helping you to understand one simple term at a time.